UnitedHealth recently reported Q2 2025 earnings, and the stock has cratered. Medical costs are up, margins are down, and the company just halved its EPS guidance for the year. So is UNH stock broken, or is it a rare opportunity to buy a healthcare giant on the ropes? In this video, I will break down what's really happening at UnitedHealth, how bad the margin pressure is, and then walk you through the bear, the base, and the bull case for where the stock could go from here. Let's dive in. Before we begin, a quick disclaimer. This video is for educational and informational purposes only. It's not a buy or sell recommendation. Please do your own research before investing. So let's quickly review the Q2 earnings. UnitedHealth posted Q2 revenues of about $111 billion. That's up roughly 13% year over year, driven by both its insurance arm, United Healthcare, and its Optum Health Services business. But here's the issue. EPS dropped to about $4, down almost 40% from $6.80 last year. And operating earnings fell from about $7.9 billion to about $5.2 billion. Most concerning, the consolidated medical cost ratio jumped to about 89.4%, and that's the highest it has been in years. So what does that mean? For every dollar of premium revenue, nearly 90 cents went to paying out medical claims. And that leaves very little margin to run the business or generate profit, especially in Medicare Advantage, where utilization is spiking. Looking at the business segments, the insurance division, United Healthcare, grew revenues about 17% to $86 billion, and it serves about 50 million members. But earnings dropped nearly 50%, with margins falling from 5.4 to just 2.4%. Optum's revenues hit $67 billion, growing about 7%. But here too, value-based care contracts saw margin stress. Management now expects a longer recovery path, and that puts the entire integrated model into question. Let's talk about the guidance. UnitedHealth has reset full-year EPS to at least $16, down from about $29.50 a few months ago. Three things are driving the EPS cut. Higher than expected medical utilization, about $1.2 billion in ACA and legal settlements, and structural pricing mismatches in Medicare Advantage. Management is now focused on $1 billion in cost cuts, smarter pricing, and AI-led efficiencies by 2026. But remember, healthcare pricing resets take time, often 12 to 18 months. So 2025 is going to be a margin repair year. The market doesn't like that kind of uncertainty, and it shows in the price. Now, let's take a look at various valuation scenarios. First, let's look at the bear case. Let's assume that medical costs remain high, regulatory probes drag on, and 2026 EPS recovery underwhelms. Now, they've guided for about $16 in EPS. Assuming a 14 times multiple, we get to a fair value of about $224. That's a downside risk of about 8 to 10% from today's levels. Now let's consider a base case where the EPS rebounds to about $20 to $21 by 2026. Margins gradually improve, Medicare pricing resets sticks, and Optum stabilizes. In this case, assume a 16 times multiple, we get to a value of $336. That's an upside of about 38 to 40% from the current price. Let's consider the bull case, which some analysts are expecting. Let's say EPS is about $24 to $25 by 2026. The sentiment rebound. Margin reset succeeds early, AI boosts Optum productivity, and the DOJ investigation closes cleanly. Considering a 17 times multiple, you get a fair value of about $425. That's about a 75% potential from current price. If you are investing in UNH, you really need to watch a few things going forward. Because with a company like UnitedHealth, the margin of error is thin and the recovery path will be shaped quarter by quarter. Here's what I will be tracking. First, medical cost ratio, especially within Medicare Advantage. That's the number that tells us how much of UnitedHealth's premium revenue is being eaten up by actual medical expenses. The company reported a spike to 89.4% this quarter, and anything above 88% in the coming quarters is going to be a red flag. If we start to see that number stabilize, or better yet, decline, it would signal that pricing is catching up to the cost curve and that utilization trends are moderating. Second, margins at Optum. While Optum is still growing top-line revenues, the real story is in profitability. Management flagged operational friction in their value-based care business. That tells us there's execution risk. So I'll be looking closely at Optum's operating earnings and margins trajectory each quarter. Are they making progress on cost discipline and care delivery efficiency? Are AI and automation actually showing up in the bottom line? If not, we could be looking at a longer than expected drag on earnings. Third, keep an eye on membership trends, particularly in the ACA exchange plans and Medicare Advantage. This quarter, UNH took a $620 million hit tied to anticipated losses in their individual exchange business. That's a signal that either pricing wasn't set appropriately or that patient risk pools are worse than expected. If member churn starts to rise, or if enrollment growth slows in these segments, that would weaken the forward revenue base. Fourth, and this one's a little more opaque but important, legal and regulatory updates. The company has been under scrutiny related to antitrust issues and past billing disputes. While not all of it is material yet, any fines, settlements, or reputational damage could limit M&A flexibility or cloud sentiment. Pay attention to SEC filings, footnotes in the quarterly reports, and anything management says or doesn't say during the Q&A on earning calls. And finally, I'll be tracking leadership execution and pricing strategy. The tone from the C-suite this quarter was one of stabilization and recalibration. But talk is cheap. The real test will be whether the company can reprice its Medicare Advantage contracts in time for 2026 and start rebuilding EPS momentum. Any commentary around pricing power, contracts renewal, or benefits design in upcoming quarters will be critical. So bottom line, this stock is not just a buy and forget. You'll need to track it like a hawk. To wrap it up, United Health is under real pressure, but it's not beyond repair. The business model still has depth, but management has to execute flawlessly to earn back market trust. If you're bullish on the healthcare sector long term, UNH may be worth watching. If you found this breakdown helpful, don't forget to like, subscribe, and drop in your question or comments.